In this section, we continue our discussion on the various kinds of investments and asset classes that are available. And we're going to look at specifically debt now. Now that we're done with equities, we're going to look at the asset class of debt, which is essentially how do we invest in bonds? What are the various agencies that issue bonds? What kind of bonds are available? And while some of this will recap a little bit of what we have already covered under financial management, we are going to look at a few new things about how debts work and how debt instruments work and how what kind of risk and reward structure do they provide to us, right? So now the first question is, what is debt? The connotation of debt is usually negative. We believe it's a burden, but in this particular case, as investors, we are not the guys who are borrowing, but we are guys who are lending. Remember, we are essentially buying bonds, and a bond buyer is the lender, the bond issuer is the borrower, right? So we are buying bonds. And why are we buying bonds? Is because we will get some interest income on that, and there is a possibility that we could also get what is called as a capital appreciation, right? Why can capital appreciate? If the bond prices go up, for example, right? So the question is, how can bond prices go up? So how do bond prices go up? That's what our key construct is in terms of investing in bonds. Some part of the income is fixed; it's going to come to us. Some part of the income is if the bond prices go up, right? So that's the broad idea. Let's quickly recap what we have already learned under some of our other subjects as to some key terminologies with respect to the bond markets and bonds. Face value is the value at which the bond will be redeemed, which is nothing but the principal amount at the end that will come up, right? It's not the value at which the bond is issued. Issue price could be the same as face value, or it could be something else, right? So for example, if there is a bond that's priced at rupees 1000, it is quite possible that when it goes to the market, the issue price is not 1000 but maybe is 1020, is because there is a bigger demand for buying this particular bond, right? But the face value will be 1000, right? Because that's what is assumed as the principal, and you will receive that at the end of the tenure of the particular bond, right? The term that is one part of our income is called the coupon rate, which is also what is the interest that is defined, the fixed interest defined. Coupon rate is typically as a percentage of the face value. So if the coupon rate is 8% on this 1000, we're talking about 80 as the coupon, right? So the interest rate that will be paid to the investor on a frequent basis, whatever that frequency is defined as the coupon frequency. Now that could be yearly, that could be half yearly, that could be quarterly, that could be monthly. The frequency at which the coupon is paid is basically called as the coupon frequency. Then we look at what is the maturity or tenor, which is the period after which the face value will be returned, or basically the bond life. You know, what is the life of the bond, what is the duration, the total term for which the bond is outstanding. In other words, the period for which we have basically lent the money, right? And then if the bond is trading in the market, what is the current price of the bond? If the security is listed, the last traded price of the bond, it could be different from the face value and the issue price, right? There is a fair possibility that this current price is different from the face value and issue price. So that's basically a quick recap of the key terminologies that we remember. Remember, coupon rate is the fixed payment that you will get every year, and that's why these instruments are also known as fixed income instruments, if you remember, right? Now, so broadly, that's the key terminologies. Now, the debt products that you could look at, the various kinds of debt products are available, could be direct bonds. Bonds could be issued by government. Bonds could be issued by corporate, right? They could also be issued by banks. Banks are kinds of corporate, so we could basically say that bonds would be issued either by government or government agencies and by companies, right? Then you could have mutual funds, which are funds that will invest in bonds, right? So these funds invest in bonds. So these are going to invest in bonds, and these are called as debt mutual funds. There are a variety of different kinds of mutual funds which are available. Some invest in short-term bonds, some invest in long-term bonds, etc. And then you could have something called as the national pension scheme, which could be another place where you could invest using your idea around the debt markets. And debt would also have derivatives. So we do have interest rate derivatives as well, which are available, right? Now, recall one more thing, that the bond price is basically inversely proportional to the return you will make on the bond, or what is known as yield, right? So if you're going to buy a bond at 100 and that's supposed to give 110, that's a return of 10%, correct? But if the price falls to 99 and you're still going to make 110, the yield would have gone up to somewhere around 11%. If the price goes to 101, you're still going to make 110, the yield would have gone down to somewhere around 9%, right? So you will note that the price and the yield are different, and the yield is nothing but the measure of interest rates in the economy. So essentially, what is the current interest rate in the economy is typically derived by what is going to be the yield. Now, because this premise is inversely proportional, one of the ways you can make money is if interest rates go down, right? We'll look at that now. So what happens if, let's say, interest rates in the economy go down? If interest rates in the economy go down, in a sense, what is happening is that yesterday there was a bond that was bought at 100 and that was giving 110. This was old bond. Today there is a new bond which is coming at 100 and that's giving 108, right? So effectively that's the new bond. Now what will happen? If this is the new bond, then demand will rise for which bond? The first one, because it's giving a higher amount at the end, right? Because the demand rises, the price will also rise. The price will rise till the time the price reaches somewhere around 102, such that the return you make on the old bond is about 8%, which is similar to the return on the new bond. Then a new investor can basically invest in any of these, right? So this increase in price is happening because interest rates went down. You can make capital appreciation on the bonds. If interest rates go down, bond prices go up. And because bond prices go up, you might end up making a capital appreciation, which is essentially you can sell the bond at a higher price than purchased. This is generated, the return generated is called as capital appreciation. Usually, when interest rates fall, bond price increases, and hence one will generate positive returns on that. The exact opposite is also possible. If interest rates in the economy go up, then bond prices will fall down and you will make negative returns, right? So it's important that when you're buying debt instruments, that in addition to the fixed income that you're going to make on the coupon, what is your view on the interest rate is important. Do you think interest rates will go up or do you think interest rates will go down, right? And the second part basically is essentially the coupon that you make, which we already know. This is the fixed payment that we are going to receive. Every bond will have a coupon rate attached to it, usually, which is fixed in nature, essentially, right? So you will receive this money. As long as you have the bond, you will receive coupon after the prescribed interval. It's just like an FD, a fixed deposit, right? Usually the bond yields or the bond returns, coupon rates are again in the range of what interest rate is prevalent in the economy. So if the interest rate in the economy is around 7 to 8%, you typically see coupon on various bonds being in the range of 6 to 9% roughly, right? So you could make money either if interest rates go down on account of capital appreciation, or if you just hold a bond, you could make money in the form of coupon rates on the bond, right? Now, this is a chart that shows, what has been monthly, the 10-year bond yield, government bond yield in India, right? In a way, this is nothing but the long-term interest rate in India, right? So you will see that this rate used to hover in the range of close to about 8% all this while between 2006, 7 and this, and in 8 it went up to an extent. Then there was a global slowdown, right? This is where the global crisis happened. When that happened, almost all central banks cut interest rates to close to 5%, and our RBI cut it to close to 5%. Then there was a slow and steady increase in interest rates. As the RBI increased rates, automatically the bond yields went up. Slight decline in rates, jump in rates, and then decline in rates, right? In the yields. Now, if you look at it, what is the time when bondholders would have made money on this, right? So let's see. Here, yields have gone up between point A and point B. Yields going up would mean negative return because prices would have gone down. From point B to point C, you would have made positive return because yields just fell dramatically from 8-9% onwards to 5%, right? From C to point D, you would again make negative returns because yields have gone up, prices would fall. D to E is positive, E to F is negative, and F to G is positive. So looking at the yields, you can get a sense of when the bond yields are going down, you're going to make money. So that's the important yardstick that you look at when you're kind of investing in debt instruments, that if you believe interest rates are going to go down, it's an instrument that will give you capital appreciation. Remember, these returns we have spoken about are only capital appreciation. Note, if you hold a bond for a longer period, you will receive some coupon, and if you hold it to maturity, interest rate movements don't impact because the final price is fixed, right? So if you buy a bond at 100 and it's a 10-year or a 3-year bond, for example, and gives you 10, 10 and 110, if you hold it to maturity, which is the third year, you will surely receive 10, 10 and 110, in which case your return is fixed. Only if you sell it in between is where this concept of capital appreciation will come in. So you have to sell the bond in between. If you hold it to maturity, there isn't going to be a capital appreciation. Whatever is given on the bond then is fixed essentially, right? Let's take a quick look at 10-year government bond yields for various countries at this point of time. So we are looking at a very interesting phenomenon around the world right now, which is called as negative interest rates. Now, while the actual discussion of negative interest rates is probably going to be beyond the scope here, some of the central banks like Japan and the European Commercial Bank have cut down yields to a point where the bonds are actually giving negative returns. Yet people are investing in them. So basically you invest 101 in the bond, which is going to give 100. That's effectively the scenario. You still do it because these are considered as safe instruments or safer instruments in those economies. There are economies like France, Canada, Italy, US, which are running at significantly lower interest rates. India's 10-year bond yield is around 7.4% at this point of time. A couple of countries where yields are high is this. So interest rate is high in Brazil because inflation is high. Almost same is the problem with Russia as well. So Russia is also high because inflation is high. So that's the prevalent 10-year government bond yield in the global economies, and we see we are still one of the higher interest rate economies in the world. That's purely because inflation is typically higher in a country like India, right? So that's the discussion on 10-year government bond yields. Now, what is an important parameter when you're looking at bonds or debt investments is essentially the fact that you have to kind of understand a few major parameters. First is, if you give loan for a short period, right? Give loan for 1 day versus 10 years. Where is the risk higher? This is risk is low, here risk is high. So shorter the tenure of the bond or debt security, lesser the perceived risk, right? If the risk is perceived to be lesser, then the return expected would be lesser. Because the risk perceived is more in longer dated bonds, longer tenure bonds will trade at higher yields. Correct? If you remember, we also have what was called as the yield curve, and the direction, the diagram of yield curve would appear something like this, right? Where this was the time and this was the rate of return. So effectively, as time increases, 10-year, 9-year, 8-year, 7-year, the yield expected keeps increasing in a normal scenario. You would believe that if you're holding the bond for a longer period, the risk is higher, right? Similarly, the faster you receive your money, the lower the risk. So smaller the coupon, the later you will receive your money. Let's assume there is a bond that gives you 303, and there's a bond which gives you 8 and 108, right? Or maybe even gives you lesser money at the end, which is, let's say, 303 is going to be 109 in total. 8 is going to be 16, so it's going to give you only 91 at the end, right? But you're getting your money back faster in the second bond, and hence the risk perceived would be higher in the first bond. Smaller the coupon of a bond or debt security, higher the perceived risk, because it will take longer to receive your money back, right? Then lower the credit rating of the bond. Remember, we had seen that rating agencies like CRISIL and ICRA give you a rating of the bond, which basically says how risky the bond is. We'll look at that as well in a moment. Higher the perceived risk and higher the yield of this particular bond. The impact of interest rate movement is higher for bonds with higher maturity than with lower maturity. Thus, if you expect rates to go down, you should buy longer maturity bonds, right? Since they will go up more than shorter duration bonds, right? On the other hand, if you expect interest rates to go up, then longer maturity bonds will lose more money. So you want to be in shorter duration bonds. Think of it this way. If interest rates are going to go down, you will go to a bank and block a fixed deposit for the longest tenure, right? Today you are getting 8%, tomorrow you might get 7%. So you'll say, boss, I'll block 8% for 10 years. So you would want to go and invest in the longest tenure instrument. If interest rates are going up and tomorrow you could get a bigger interest rate, then you will look at the shortest possible tenure. You will probably invest in a fixed deposit for 1 day, and then tomorrow you could get a better rate, correct? So this concept of duration is what we will recap now. Remember, duration is the measure of the price sensitivity to the changes in yield in the interest rate, right? So duration of a bond gives us a measure of how the bond will move with 1 percentage point moves in the yields. It's an approximate measure essentially, right? So if you have a bond with a coupon rate of 8%, tenure of 5 years, face value of rupees 100 and YTM of 7.2%, you can calculate the current price using the functions or manually calculating it using time value of money. You will realize that the change is going to give you what is called as the duration. Now, duration for longer bonds is higher. When we say longer bonds, longer duration, longer maturity bonds is higher, and that for shorter maturity is lower, which logically means that interest rate sensitivity is higher. Interest rate sensitivity is high for longer maturity bonds. Now, why is that important? So as we discussed earlier, if you expect interest rates to go down, if you expect the interest rates to go down, you would want to buy longer maturity bonds, right? Longer duration bonds, because they will go up more. You want higher sensitivity, right, than shorter duration bonds. On the other hand, if you expect rates to go up, you want to be in shorter duration bonds because you want lower sensitivity. You don't want to lose money now, or you want to lose money at a smaller clip than you would do otherwise. So that's how duration becomes an important parameter, and this is one of the important points that you would want to remember while investing in bonds. The second part while investing in bonds is the concept of credit rating, where a rating agency would come and talk about whether the bond has highest safety, high safety, adequate safety, inadequate safety, risk prone, or default territory. You could also get capital appreciation, right? So in a lot of the cases, the bonds will give you capital appreciation if interest rates fall, right? So how does interest rate fall? Let's say someone upgrades a double B bond to A, right? So there is an upgrade. A rating agency has upgraded a bond. The moment you upgrade a bond, risk perception declines. Risk perception declines, meaning you would require lesser compensation for this or lesser reward or return for this. And if return goes down, that basically means yield goes down. That would essentially mean the price of this bond would go up, and you could make capital appreciation. If you buy a bond and that particular bond's rating gets upgraded, you could make money on capital appreciation based on that as well. In a sense, the yield on that bond will go down, which is the same as interest rates going down, right? So there are various rating agencies like CRISIL, ICRA, and CARE. It's important to look at what ratings are available to the bonds that become a part of your portfolio, right? So those are the key bond ratings. A quick look at what are the key risks while investing in bonds. So if you're investing in bonds, one of the problems you face in a country like India is that bond markets are not very mature, right? And hence liquidity is a problem. What do we mean liquidity is a problem? If you want to buy a bond or sell a bond, you don't find a buyer at your end. You don't find the counterparty. So NSE, for example, has what is called as a wholesale debt market, which allows trades. But the problem is the trade will only happen when there is both bid and ask available. If the bid or ask one of these is not available, or there's a very wide variance in that, right, then there is a problem. So for example, if it is illiquid, the buyer might say, I want to buy at 1000, but the seller might say, I want to sell at 1040, right? Now, if you think about this, there is a 4% gap. And if you move away from your price, let's say the buyer says, okay, I really want to buy this and ends up paying 1040, then you have already given up 4% of your return, correct? Because the final price is fixed in a fixed instrument, fixed income instrument, right? The view on interest rate decides what bonds to invest into. If the view gets changed or challenged due to higher inflation, then bonds could result in losses. So it's not like bonds cannot lose money. Bonds do not lose money if you hold them to maturity, right? So if you're holding the bond to maturity, then it's a no loss scenario. Even then it is not a no loss scenario, because you could have what is called as a default risk. The company raising money through bonds could actually default. They may just not pay you. But if there is no default and you hold the bond to maturity, then in that case you will not lose money on capital erosion, right? Finally, there could also be what is called as a credit risk. The company raising money could see a credit downgrade. We saw an example of a credit upgrade from double B to, let's say, A. You could also see the other way around, where essentially a higher rated security could get downgraded if new information comes into the markets, right? Those are the primary risks that come up when you're investing in bonds. So that broadly brings us to an end of our understanding on the bond questions. The key understanding that we need to have in terms of bonds, let's try and answer a couple of questions based on that. If interest rates are expected to go down, should an investor invest in a 1-year bond or a 10-year bond, short duration versus long duration? What are the various risks that you come across while investing in bonds?